One thing they used to say in Wall Street is you never fight the tape. And the tape is going down. Both are clearly in bear market territory now. They're down more than 20% from their peaks. And in fact, silver's down 50%. All the factors to drive the gold price and for other reasons the silver price higher are still in place. Nothing's gone away. A couple of years ago we were looking at an interest cost of about 8% of the tax take is now surpassed 14% of the tax take, and it's going to go beyond 22% in the next couple of years according to the Bureau of Labor Statistics' own numbers. So the interest burden is rising rapidly because the debt is rising faster than GDP. So this is getting out of control. What they can do is revalue gold that the Treasury holds. The Treasury is the government. The US government holds a lot of gold. They could revalue it to the market value or a much higher value. And I think the argument is strong that they should do it to a much higher value.
Hey everyone, this is Elijah K. Johnson with Liberty in Finance, and back with us today is our good friend Clive Thompson, retired wealth manager from Switzerland. Clive, thank you so much for joining us today.
Hello Elijah, and thank you very much for having me back on your show. I can't actually believe it's now 4 years since I retired. The time has just gone so fast. So all I can say to people who are thinking of retiring, retire a bit earlier, because when you've retired, it's going to go very fast.
Well, it's been an exciting 4 years, and I don't know if retired is the best sense, because I know you've been doing a lot. You've been writing children's books, the little Trot series, which we'll talk about, and also your YouTube channel, really reporting on the markets, especially the precious metal markets, having a whole portfolio analysis and all that. And we'd like to get into that. First, the elephant in the room is obviously the silver price collapsing and gold price collapsing as we speak. What is your take on the sentiment right now in the metal space?
Well, both are clearly in bear market territory now. They're down more than 20% from their peaks. And in fact, silver's down 50% and something from its peak. So the peak was $125. It's now, let's call it $62, $63. I mean, maybe it'll be $1 different when you publish this video. The thing which is causing the price, or which everybody says is causing the price fall, has been the prospect of higher interest rates due to higher inflation, and the higher inflation is caused by the war. So, traditionally we look at political crisis as potentially being good for precious metals, although in my career I haven't really seen any strong evidence of that. We're not back in 1945 where people had to fill their pockets with gold and cross the border. But despite the political tensions, they are causing the higher oil price, and the higher oil price will feed through to higher inflation. And that basically means the world is now expecting interest rates to rise. We've got a dead certainty of rises in Europe, the UK, and almost certainly in the United States later this year, probably in December. So higher interest rates, at least the nominal higher interest rates, make people think, I don't want to hold gold, I don't want to hold silver because there's a carry cost, I'm earning nothing. I might as well go into short-term deposits and earn some money. The other side of the coin, I think, is that people have been, up until maybe a week ago, although that's not turned around in direction, but people have been taking money out of gold and silver to put into the fastest moving assets. And the fastest moving assets have been everything to do with data centers, silicon, AI, all that sort of thing. So we've seen almost daily for the last few weeks, last month or so, almost daily, there's 2 or 3 stocks which got 10 or 20% on the back of some story. So a lot of people have been chasing that, saying, well, okay, I missed the last one. It's hurting. Gosh, I meant to buy this, or I meant to buy that. And now it's gone up 20%. So they're kind of running a little bit, trying to find the next one. And I think the money's been coming out of gold and silver miners and gold miners, going into the AI sector. Now, of course, that sector is, as we speak, looking like it's slowing down. It's up today, but it had a very bad day yesterday. So money looks like it's coming out of the bag a little bit. I could perhaps talk about that in a minute or two as to why I think we might have seen the best of it.
It does seem like we're seeing multiple factors here as you analyze that the prospect for higher interest rates is pushing the market down and gold and silver down. And we saw that high inflation number here in the US of 4%, the highest we've seen in years. Kind of laughable because obviously it's higher than that, but as the official number. And then we have as well, we have the SpaceX IPO coming out just tomorrow. We're recording this on June 11th here. And that you've mentioned is really sucking liquidity out of the market. Can you expand on that?
So the amount of liquidity being sucked out of the stock market relative to the size of the stock market is not very large at all. It's tiny, but it's at the margin. And we're still talking some $250 billion of applications for this $75 billion issue. So it's quite likely that people have raised cash to the tune of $250 billion to go into this issue. Now, it's not like $250 billion is a big amount relative to the total, but at the margin, someone is being sold stock when we're already in a rather overbought situation. So this sector, the AI sector, the large mega cap companies were rather overbought, meaning now there's sellers of some of those stocks trying to sell those stocks into an already overbought market. So there's a sort of reluctance from other people to buy the stocks off the sellers, which is why the stocks have been going down. But I think what's good, we will see how it develops, because once people have got their SpaceX shares, things will have settled down. I suppose the money probably will head back where it started from. Obviously, the nice thing would be if it goes in the direction of gold or silver. We don't see any evidence of that happening yet.
As we mentioned at the top of this interview, sentiment is extremely low in the precious metal space, where I am seeing on the retail side a little bit more action, people trying to buy the dip at the moment. But do you anticipate that we could be going lower before things get better? Or what is your outlook for especially silver, but also gold?
In the long run, I'm very confident that we'll go a lot higher. All the factors to drive the gold price, and for other reasons, the silver price higher, are still in place. Nothing's gone away. But one thing they used to say in Wall Street is you never fight the tape. And the tape is going down. So gold is around just a tad over $4,000 as we speak. I would much rather be a buyer of gold at 4,400 than at 4,000. Now that may be hard to understand, but when it's at 4,400, you've got a feeling that it's now moving in the right direction. And I don't want it to go to 4,400 tomorrow. I want it to gradually grind up there until I say, gosh, I'm missing out on this. I got to get in. So this is the saucer. We're going down the saucer. We don't know if we're at the bottom of the saucer. Might be there, might be there, might be there, or we might be at it. But then I want to be actually getting a feeling I'm going up the other side. Now, there's no maths or chart you could look at to tell you exactly when you're there. You can only get a feeling for it. But right now, my feeling is that if you're a stacker, as I am, it's a great move to keep buying little by little by little. But this is for those people who are sort of saying, I'm already at my peak of silver and I want more. I wouldn't go overweight in it at the moment. I'd wait for it to go a bit lower if it does and stack up. And if it doesn't, you're fine because you've got some silver already. But if you've got no silver, definitely start buying. That's my view. But that's not a prediction it's going higher tomorrow. We don't know that. But the point is, if you stack slowly but surely, you will catch the bottom of the saucer wherever it is. So we might be here, we might be there, or we're not yet, but we might be going up the other side.
You've mentioned people who are looking to, buy the dip and time the market can sometimes it's difficult, and it also might not be the right way to think about it. The dollar cost averaging might be better, because you mentioned in a recent article you wrote that if you're wanting to buy the dip, there will probably be, there might not be new all-time lows. There are almost certainly, we can't guarantee this, but in your view, almost certainly going to be many, many, many more all-time highs. So if I remember back when silver was, just breaking above 50, it came down a little bit. A lot of analysts were saying it's going to 40, right? And I was like, oh, maybe I'll wait to 40. Well, it didn't turn back, right? So if we're at 60, 3 or whatnot today, and we're waiting for 50, if you don't already have a good position or where you want to be, where you're comfortable at, waiting for the perfect time to put everything in, you might not get that opportunity.
I mean, that would be wonderful. We could put everything in at the bottom. But to be honest with you, I know of nobody who ever bought anything at the bottom, or of anybody who sold everything at the top. The way to play the game is you put some in and you put some in. So if you buy some at 50 and then at 45 and then at 40, then at 45, then at 50, then at 60, then at 70, then at 80. Yes, you might be quite annoyed that you didn't buy the whole lot at 40. And you'd be a little bit annoyed that you paid for some at 60 when it's now 80 and you could have paid 40. But at least you've got in at reasonable prices compared with where it will probably be. And I don't think that the all-time high we saw of 125 is where it's going to stop. There are plenty of people out there who think they know what they're saying, who are printing prices higher than the all-time high even this year. I'm hoping they're right. But what I can say is this. We're in a silver shortage. That's confirmed by the Silver Institute, where they're forecasting a bigger deficit in 2026 than there was in 2025. That deficit has to come from somewhere, and the only way it can come from somewhere is from sellers. So it's not going to come out of the mines because the mines aren't producing enough. It's got to come from sellers of ETFs, sellers of physical bars or coins or recycled silver. And the way, although every ounce on the planet has got its price, and that price does move around according to how people feel, to get that silver to meet the demand, at some point, silver has to start moving higher. And when it starts moving higher, I think that becomes self-fulfilling. Therefore, people start to move their target price where I'm going to sell. So those who are willing to sell at 80 today are probably going to move their target price to 85. And so on. And then when it gets to near to 85, they'll move it up because the momentum itself changes the way people think about what their target is. So on the way down, people gradually lower their target to 10 or 20% above the present price. But on the way up, they tend to keep their target 10 or 20% above where it is on the way up. So the silver price really has to rise to suck that silver out for the purposes of the industrial needs.
You recently did a study on silver miners and how, when they released their results, how their stock price reacted to that. And one of the things that people have been talking about for quite a while is as silver has gone up from its low of $20 or so to 120, ever since it was $30, $40, $50. These silver miners are making huge profits, and it doesn't necessarily. It's great if silver is at 120, but $60 silver, $50 silver, that's still fantastic for a lot of these miners. And a lot of analysts you found were probably not factoring this in. They were underpricing these stocks. And then when results, when revenue was released and all that, they were shocked and prices went up. I think you had mentioned on average about 10% over that period. So can you expand on what you studied there, and then what do you forecast for the future for a lot of these miners?
Sure. So we've had the result. I've looked at all the results, or the last results, of the top 36 miners. For that I used the SIL, the Global X Silver Miners ETF, to choose which were the top ones. So I chose the largest holdings by size. So that, broadly speaking, is the largest companies. What I discovered was that, and I reduced the database from 35 to only 16. The reason I reduced it to 16 was I eliminated all the loss-making companies, and I eliminated all the companies with price-earnings ratios in the sky. In other words, everything with a price-earnings ratio above 26 times. So out of the top miners, and most of these were really at the top of the pile, there were 16 companies which have a price-earnings ratio below 26. I looked at the price before they announced their results and the price after they announced their results, and most of them went up on the results announcement. So I thought, what if I'd bought every single one of them exactly 7 days before the results were announced and sold it exactly 7 days after the results were announced? And the conclusion, I've got it on my screen in front of me, and everyone can go and look at this on my webpage. It's on clivethompson.com. And you scroll down to the bottom, you'll see a link to it. So you can see the numbers, you can see everything there. But what I discovered is, on average, you would have made a profit of 11.49% buying 7 days before and selling 7 days afterwards. And that is because those miners across the board were producing results which were mostly better than expected. Out of the 16 companies, only 3 went down. That means 13 went up. And of the ones which went up, a lot of them went up by a lot. I'm looking at numbers, almost all of them double digits. So if I just run my eye down the percentages, the first one 13.95, then 7, then 14.58, then 22.27, then there was a minus 40. That's one of the 3 which lost. Plus 19, plus 22, plus 20, minus 20, because that's the second loss, and 23.8 and so on. So we've got a lot of double-digit gains averaging out, including the losses, at 11.49% profit. Now, what does that mean for the results coming up in June? So the next set of results will be for the quarter ended June, or in some cases for the half year ended June. All those profits we already can anticipate will be much higher than they were a year ago, because the average silver price over the last 3 months and 6 months and 12 months has been a lot higher than it was in the same quarter, the June quarter, 2025. That means the mining companies have been making much more profit this quarter than they made exactly a year ago. So they will be showing a year-on-year profit increase, which will be substantial. Revenue increase and profit increase, and I'm assuming almost every single one of them. What we don't know this, but I'm speculating that for those who want to take a chance, you look at the ones which are going to have the biggest profit increase, and there's a table on my website you can look at to see that. I'm speculating the ones with the biggest profits increases will be the ones which will move the most when those results are actually announced. Now, this is only speculation, but it'd be repeating what happened in Q1 for those companies. 13 out of 16 went up a lot, and perhaps a large percentage could go up again. No guarantee it's going to happen, but I think it was an interesting exercise to discover that the analysts were just too cautious at the end of the last quarter.
And for those who are bullish on silver long term, it is interesting to note that the price of a lot of these miners have fallen significantly since silver has cooled off here. So again, it seems like there is a good argument to be made that, the market is not pricing in these higher profits at these higher prices.
The market has become overly negative. I've measured the silver prices via the ETFs and via direct silver companies compared with the last time silver was at this price on the way up. If you held a portfolio of these companies, diversified, or the ETF, you would have less value today than you had at the last time the silver price was at this level when it was on the way up, and significantly less. So the silver miners have underperformed. They've become overly pessimistic in the light of the recent fall in the silver price. So that means to me, if you're buying into silver miners today, you're getting it at what seems like at a time when people are overly pessimistic. Doesn't mean to say it's the bottom. We don't know that. Nobody can tell you that. It might be, it might not be. But I always say, if you're going to go do it gradually, a little, maybe 1/3 now, then wait a while and do another third. And don't be frightened if you're paying less, and don't be frightened if you're paying more in a month or 2 months, or whatever you decide to do your next lot than you did before. And then wait a bit more and do your remaining third. That way, you're definitely not the fool in the room, because you will have a range of prices. And if it's going up, you'll be laughing all the way to the bank, because you've got prices that you paid which are lower than the price on the way up. And if it's going down, you can say, I was a smart cookie because I didn't buy it all at that higher price. I was a wise guy. I used to buy it down. So as you buy on the way down, if it does go down, we don't know it will, but if it does, at least you're getting prices which are closer and closer to whatever the bottom will turn out to be. I know from experience, when I've done this with equities of all kinds, I feel a lot happier than when I go all in. When I say all in, I mean an entirety of what I would intend to put in one go, because when you go all in, you 50% of the time it's going to go down the next day, and you're going to feel frustrated. If I do go into the tune of 1/3, I'm happy that I only did 1/3, and if it goes up, I'm still happy because I made a profit. It's a question of the mindset, isn't it? How you, some people say, oh, the glass is half empty, and other people say, wow, it's still half full.
Certainly, but I think a lot of your work has to do with reducing risk. And with your background as a wealth manager, you look at the Sharpe ratio as well. How, what kind of reward you can get while having the lowest risk. And you've analyzed also having gold in your portfolio, and it seems like practically every if we look at the prices throughout recent history, pretty much every single option of different portfolio allocations, it's always good to have gold in your portfolio. And it does depend on the time frame, but one of the best allocation that you found was not a 60-40 traditional or conventional stock bond portfolio, but it was better to replace some of the bonds with gold. And even it seems like one of the best ones you had was 60% stocks, only 10% bonds, and 30% gold, which most wealth managers would be like, what in the world? That's a huge over allocation to gold. But for at least the time frame that you were looking at it, it did very, very well. Can you expand on how replacing gold or replacing bonds with gold really is a better long-term play?
Yep. So first of all, the optimal asset allocation very much depends on your start date. So if you start in 1970, the optimal asset allocation is different from your optimal in 1975, different from 1980, and different in 1990, 2020, and so on. So depending on your start date, the optimal asset allocation will be different if you're looking forwards over time. And I've done hundreds of tests, and I have a portfolio simulator on my website called Clive Thompson, which anyone can go to. It's free of charge, no registration, not even an email address needed. And you can put in any asset allocation you like to test this. You can put in any starting date you like to test this. But the conclusion is the following. Over virtually any period, i.e. any starting date until today, having some gold in your portfolio would have improved its return. It would have improved its Sharpe ratio compared with the traditional 60-40 portfolio, and it would have reduced the biggest loss. That's a peak to trough cycle. It would have reduced the biggest loss from whatever it was to a smaller loss if you had gold. Now, the optimal amount of gold does somewhat vary according to your starting date, but what I can say is, had you put in around 30% of gold at any time in history, it would have improved your portfolio compared with a 60-40. So 60-40 would be 60% equities, 40 bonds. If instead you'd had 60 equities, 30 gold, and 10 long-term bonds, you would have done better on all the metrics. Now, it doesn't mean to say that every single date in history, 60, 30, 10 was better than some other ratio, but what it does mean is having some gold. So, for example, in the last 5 or 10 years, the best ratio would have been more like, I can tell you, I've got it in front of me here. If you started now, if you started in June 21, that's 5 years ago, your best ratio would have been 35 equities and 64 or 65 gold. If you go back 10 years before that, it would have been 65 equities and 35% gold, zero, in both cases, zero bonds. But as I go back in time, let's say to 1991, the correct ratio would have been 48 equities, 23 bonds, and 28 gold. But overall, 30% gold would have been the perfect number if you couldn't choose your starting date.
And it sounds like you're using the computer essentially to calculate, thousands and possibly hundreds of thousands of different combinations for different date ranges. So it's not just like picking a couple here. It's actually like looking at pretty much all the different permutations you could think of.
Well, I've looked at on the three asset classes, gold, bonds, and equities. I've looked at every date range up until 2021. When I say up until 2020, there's not a lot of point in looking at beyond 2021, because beyond 2021, the optimal would have been 100% gold, to be honest with you. But up until 2020, so starting from 1970 or 1980 or 1990 or 2010 or 2020 or 2021, all of those dates, you should have had gold in your portfolio with hindsight to improve your Sharpe ratio and other things like your performance or your drawdown. We can optimize that by changing the asset class. So on my website, you can put in any asset class you like. You can put in emerging market bonds. You can put in emerging equities. You can put in real estate, US real estate. You can put in UK real estate. You can put in the UK index. You can put in probably about 25 to 30 different asset classes, including Bitcoin, and silver is there as well. So you can choose your asset classes, add your mix, add your percentages, and you can choose whether to rebalance monthly, quarterly, annually, or never. You can choose whether there's a fee comes out, because real life portfolios have a fee, including taxation, if you like. So I put in a fee of 1 or 1.5%, which is taken in installments every 3 months. So you can put in a fee when you do simulation, but you can simulate basically anything, and it will tell you what your return is, what your Sharpe ratio is for any portfolio, what your biggest loss would have been, and it will show you month by month how your portfolio evolved, and it will compare it with any benchmark you choose. You can choose a benchmark of S&P or a benchmark of gold or benchmark of Bitcoin or whatever you like as a benchmark, and it will compare your performance with the benchmark.
And I think this is, again, completely in contradiction to what the majority of conventional wealth managers are doing. They have almost practically nothing in gold right now, and they think that gold is this crazy, extremely volatile, risky asset. But as you've demonstrated, it actually having a good portion of your portfolio in gold, at least based on the data that you have from what we have from the past, is actually better and reduces your risk and increases your reward. And I guess, what is your take on that? Because a lot of people say, it's too risky. Gold is in a bubble right now. But you've mentioned before how actually that doesn't make any sense, because it's extremely under-owned at the moment. No one wants to touch it. If you look at the majority of conventional wealth managers. So what does that say about how they're wrong? And then also, what kind of, where are we in the gold market? It seems like definitely not the popping of a bubble at the moment.
Well, first of all, unless we find an asteroid full of gold, and I don't think there's much prospect of that, gold is not going to go to zero. So in that respect, it's the safest asset you could have in your portfolio. It's safer than a bank deposit, which can easily go to zero due to the counterparty risk. It's safer than some of the largest AI-related companies. Let me give you an example. The fees that everyone is paying, and there's only about 5% of those who are using AI who are actually paying fees. The fees aren't even covering the electricity costs. So people are paying in $50 billion a year to the AI companies for the usage of AI. But the electricity costs are coming in way above that. And on top of that, they're incurring this year $800 billion of capital expenditure, which next year will be $1 trillion of capital expenditure. The year after, it'll be $1.2 trillion of capital expenditure, according to the predictions, compared with this revenue, which is coming in from users of, let's call it 50 billion for simplicity, which is a tiny fraction of what they're spending. Now, capital expenditure, of course, is, in inverted commas, supposed to be an investment which generates that revenue, but that revenue isn't covering the electricity cost at the moment. So every big AI company is going hell for leather to try and sell their services below what it really costs in order to maximize users, maximize usability. So they're all working like crazy to train their models, to produce better and better models. They're going crazy to get the data centers running. They're buying the best NVIDIA chips. And all of this, the data centers, the training, the NVIDIA chips, all of this must have a depreciation rate. What if they never get, let's say some of them never, and I'm sure this will be the case, some of them will never get to profitability and the users go away. What have they got left? What's it worth? Well, the answer is it's worth very little, and they might in fact become insolvent, some of them. So they could go, even these wonderful companies potentially could go to zero. Your gold price is not going to go to zero, but there's another factor which is quite important. Even if equities do rise and continue rising, which I think they will, you constantly have to be on the ball with equities. You have to be thinking, where should I be parked now? Should I be in the AI sector? Should I be in the utilities? Should I be in the oil sector? Should I be in the medical sector? Should I be in America? Should I be in Europe? Should I be in emerging markets? Should I be in Asia? You have to move it around. Those are taxable events. If you have some gold in your portfolio, you don't have to move it around. You don't have to be thinking, I'm selling it this year, buying it back next year. Because your risk of it going to zero is not there. You could just keep it forever and ever and ever. And because you're keeping it forever and ever, your tax bill overall goes down because you're deferring your tax until some distant date in the future when you might well be dead before it ever has to be sold.
And besides reducing risk in one's portfolio, there is a narrative, a potential for gold to rise significantly in the future. And we've talked about the fundamentals even on this podcast for precious metals. But one of the things I wanted to get an update from you on is the potential of gold being revalued and the need, you say, that the U.S. has to revalue gold. What are your latest thoughts on that?
The U.S. debt is rising at a faster pace than GDP. And the interest payments on that debt are rising at an even faster pace. And the reason interest payments are rising faster is we have a lot of debt which was taken out 5, 7, 8, 10 years ago by the government when interest rates were effectively zero. They would have paid 1 or 1.5%. That debt is maturing and they're having to pay 4.5% for a 10-year bond now. So they're paying maybe 3 or 4 times as much to roll over the maturing debt in terms of future interest. So according to any common sense, but also according to the Bureau of Labor Statistics' own numbers, which you can look on their website and see their future forecast for where how the U.S. finances are going to go, the interest burden is going to spiral and keep spiraling upwards. It won't be very many years, probably no more than a decade, before the interest exceeds the totality of the tax collection. Now, we can argue about when it happens, but at a couple of years ago, we were looking at an interest cost of about 8% of the tax take. Is now surpassed 14% of the tax take, and it's going to go beyond 22% in the next couple of years, according to the Bureau of Labor Statistics' own numbers. So the interest burden is rising rapidly on a debt, and that's partly because of the maturing debt, but also more importantly, because the debt is rising faster than GDP. So the debt is rising, the total sum of debt is rising faster than they can collect taxes, because if GDP goes up by 10%, they can collect maybe 10% more taxes. But if the debt rises by 20, and these are exaggerated figures, then you've got that extra interest payment on that a much higher debt level. So this is getting out of control. Now, what they can do to solve that problem temporarily, and this could be a permanent problem solving, what they can do is revalue gold that the Treasury holds. The Treasury is the government. The US government holds a lot of gold. They could revalue it to the market value or a much higher value. And I think the argument is strong that they should do it to a much higher value. I picked a bit of a number out of the air and said $15,000 would be a good number. The reason I chose $15,000 it's the number which will allow them to repay a little bit of debt which is maturing and fund the current year's expenditure. In other words, we can end the year next year with less debt and with having paid all the expenses. But let's just explain how they would do that and how it works. The mechanism is very straightforward, and it's a well-trodden route, so it can be done before. It's been done before in 1934 in a slightly different way, but more or less the same thing. The first step would be for the Treasury to sell its gold to the Federal Reserve at whatever price they declare is the new floor for gold. Let's say $15,000 an ounce. The Federal Reserve pays the Treasury for the gold at the market price, which is now $15,000 an ounce, let's say. That gives the government enough money to pay all the debt, all the expenditure this year and next year, and to reduce, or rather redeem, bonds which are maturing without having to take out new debt. The Federal Reserve has now got the gold, the Treasury's got the money. The next thing the Treasury does is to buy back that gold from the Federal Reserve using what's called gold notes. Now, gold notes are not new. The Federal Reserve has already got a whole bunch of gold notes from the last time they went through this exercise. Last time the Treasury bought the gold off the Federal Reserve, they gave them gold notes. But the beauty of gold notes is this. They're not part of the national debt. They don't bear any interest, and they are perpetual. So if I borrow some money from you and I give you a bit of paper saying I borrowed the money from you, but it's not part, I don't owe anybody anything because it's not part of my debt. So I'm feeling good. And by the way, I don't have to pay you any interest. And by the way, I don't ever have to repay you. I'm sitting pretty. So that's what the government should do. Now, the Federal Reserve is and can, and always has treated these gold notes that it owns as money, as an asset. So you've got two sides of the coin. Even though it's technically a liability of the government, it's not part of the national debt. And since it's never repayable, it's only redeemable if the government decides to redeem it. Basically, it's like a banknote. It's a worthless bit of paper. It's irredeemable with no interest. And the government's got, so the money's, when they've completed this exercise, the government's got its gold back in full. It's got the money. The Federal Reserve is still happy because it's got an asset, the gold notes, so its books balance. And we've got a whole bunch of money now sitting in the Treasury, which can be used to redeem the maturing debt as it comes up and to pay the ongoing expenses without having to borrow money for a year or so. Obviously, they might have to repeat this exercise in a year or two, but probably not, because the consequence of doing this exercise is it will create a shortage of Treasury bonds. So what happens when you have a shortage of Treasury bonds? The yields go down because everybody's still, number of buyers don't change. So the buyers are still there, but the number of Treasury bonds have gone down. So what happens? The prices go up, the yield goes down. And because the yield has gone down, the problem with borrowing money when they restart borrowing money in 2 years' time of having to pay higher interest rates isn't there because the interest rates are that much lower. The yields are lower. So that if they were rolling over debt at 4.5% at the moment, they'll only be rolling over at 2.5 or 1.5.
I think one of the pushbacks on that idea would be it sounds almost like an accounting trick, and that the consequences of this would be potentially, you revalue gold to 15,000. Well, what does that do with other prices, right? Don't other prices rise to match that, triple, quadruple from there? And all you're doing is really inflating away the debt. What is your perspective on that?
That's absolutely not going to happen. We've got lots and lots of evidence that it won't happen. The first and obvious bit of evidence is when they revalued gold upwards by 67% in 1934, beg your pardon. What impact did that have on prices? None whatsoever. Nothing. Didn't affect the dollar, didn't affect the prices, didn't affect anything. Likewise, we've had in the last couple of years a doubling of the gold price. Has the dollar halved? No. Have retail prices doubled? No. So the rise in gold to double the price had no effect. So why would a change in the gold price to triple the price have an effect? It probably would. I don't see why it would have an effect. The only and it won't change anything vis-a-vis the money supply. Of course, the government gets a whole bunch of money which it can spend, but at the end of the day, it was going to have to get that money anyway by increasing the debt. So it would have increased the debt, got the money, spent it anyway. So all they're doing is spending exactly the same amount of money as they would have done. What we've changed slightly is the short-term money supply goes up a bit, and the long-term money supply, which is the government debt, goes down a bit. So you just have a slight rebalance. But it's really, these days, government debt is as liquid as cash in the bank. So it really doesn't change anything about the total debt. It's not going to change the prices of anything except gold and silver.
Do you see that this would be a way to escape what we've talked about for so long, a currency crisis, a collapse of the U.S. economy? I mean, you have talked about how the U.S. debt situation is unsustainable. And even Powell said that the trajectory is unsustainable for where we are on that, which I thought was an interesting admission from him. But is this a way to actually, I guess, put the crisis to get rid of the actual crisis that we see in the future?
Well, it's a way of pushing it to the future and kicking the can down the road. And that's something which has been going on for 20 or 30 years since we came off the gold standard. So it is much of the same. So kicking the can down the road is a solution which is very acceptable to politicians because it keeps the economy going, everything stays stable, and everyone's a happy bunny. But we could eventually get into a situation where we're in a crisis. Nobody trusts the currency for whatever reason, some internal disaster, maybe a natural disaster, maybe a political crisis. And then more drastic actions needed. So the more drastic action would be some kind of currency reset or currency controls. And the way that would work would be by some sort of alternative currency being issued in whatever form. So as an example, in the UK after the Second World War, the form was ration coupons, where you couldn't, it wasn't the same thing that it is now, but you couldn't spend your money unless you had a ration coupon to go with it. So what was the real currency? Was it the ration coupon, or was it the money to buy the pound of butter? So you might have enough money to buy 5 pounds of butter, but if your ration coupon said only 1 pound of butter, that was it. That was what you're going to get. Unless you sold your ration coupon on the black market, in which case you get a very good price for it from someone who wanted 2 pounds of butter. So what's the real currency? Now, today, perhaps we're not talking about ration coupons or maybe not even capital controls. We're perhaps talking more about some kind of alternative currency which has to be used, such as the central bank digital currency, the CBDC, which becomes, for whatever reason, the unit which you have to use when you are transacting, whether you're buying capital assets or whether you're spending it on your shopping. So if all transactions have to pass via a CBDC wallet for anti-money laundering reasons, for tax reasons, for anti-terrorism reasons, these were the reasons you're given by the government, then it's very easy to one day say, all money still has to pass via your CBDC wallet, but there's a restriction on how much you could take out of your bank account to put into your CBDC wallet at the moment because we're in a national crisis. And then effectively, you slowly but surely, or very quickly, find yourself running the entire economy on the CBDC instead of running it on the money which is all around in the banks. Of course, there's going to be a lot of rules and bailouts and all kinds of things. But at the end of the day, the government is leaving behind its debt in a currency which effectively can't affect the economy anymore. It's a defunct currency because the new currency is the CBDC. Even if for a long period you were able to change it one for one, what happens when the day comes when you can't change it one for one? We're back in 1933 all over again, where $20 was an ounce of gold was $20, and suddenly one day it's not.
Well, it's certainly, I guess, a very interesting proposition for our viewers to consider. Could the gold be revalued, and could this be, I guess, a way to kick the can significantly down the road for the U.S. debt crisis. And we really appreciate your time today, Clive. It's been quite a fascinating conversation. I think our viewers will very much enjoy it here. I did want to ask you about if our viewers are interested in teaching their kids about some of the topics that we've discussed today. You have a series, the Little Trot series, and is now apparently in other languages as well, and sales are doing great on that. So tell us a bit about that.
Yes, so I've accidentally become an author of children's books. It's all started with me trying to do a video about the global financial crisis for kids, for which I needed pictures, and the pictures then turned into a book, which then turned into 5 books. So I have the 5 books. It's called the Little Trot series. This one actually is called Little Trot and the Goblin Tenants. But book number 1, which is where you start off, is Little Trot Learns to Save Money. And that is the one with the Toy Town financial crisis, where Little Trot decides to put his money into the bank, very wisely, but unfortunately the bank doesn't. So here's Little Trot depositing his money in the bank, and the banker is promising him he'll keep it safe. He says, "Now Foxy the banker, so careful and true, locked all of Trot's coins in the vault good as new. Your money is safe here," said Foxy with pride. "No one can touch it. It's locked safe inside." But then we go forward a few pages to discover that the banker has lent the money to the goblins. And we have the bank lending the money to those it should not. So it's a story, not an education book. But what it aims to do is introduce children, these books, to words which they ought to know by the age of 18, but in practice I did not know because they didn't teach it in school. There's 4 subjects you should need to know when you go into the big wide world. It's writing, reading, mathematics, and money. Unfortunately, money is not taught in school. So kids come out of school, they've got to buy a car. Well, should I save and buy it? Should I lease it? Should I borrow from the bank? Should I rent it? Which is the better option? Ask a child of 18 or 20 to give you an explanation of the merits of those. They won't even know the words. These books introduce the vocabulary at a very early age. It's from 8 to 12, or 6 to 12 actually. But that's the first step to understanding finance. And if you know the words, then you'll have a much better grasp of finance. And I've had lots of messages from people saying, "You know what? I've had the first conversation with my 16-year-old in years. Do you know what they asked me? Mummy, have you ever been bankrupt?" Or, "Mummy, have you borrowed money from the bank? Will you ever repay it?" And so the conversations now starting to happen between young and old because children are starting to use the grown-up words like interest or deposit that they've learned in the book, and they're practicing their grown-up words on their parents because they know their parents will actually give them an answer because their parents don't want to talk about Roblox or the World of Warcraft.
Fantastic. Well, it'll be exciting to hear more about that next time as well. We really appreciate your time today, Clive. If our viewers are interested in learning more, obviously there's the Little Trot series, but you have your website, clivethompson.com. Tell us a bit about your work there.
I keep getting great ideas, so I've got I built a chess program. It's a lot of fun. I don't get a lot of players, but it's got lots of features that you will find on other websites, which are quite fun, such as the ability to create your own chess problems automatically on the fly. Of course, you can play chess against AI, actually. It's using Stockfish as the engine, to be honest. But there's a lot of different things I put up on my website for people to discover. So whenever I think of something quite interesting, I just shove it up there. But people can read about gold, they can read about silver. They can, let's just see, there's a couple of my videos up there. There's some investment tools. If you want to become a Swiss citizen, now here's an interesting one. I've got the Swiss Citizen Quiz. It's, multiple choice. See if you're qualified to become a Swiss citizen by answering all the questions correctly. Of course, you do have some other requirements like living here, but let's, starting point, see if you can pass the test.
Sounds good. And I guess I should ask you, are there any last thoughts you have for our viewers, what people should be paying attention to now in the markets?
Well, be careful who you do business with first and foremost, because there's more and more trickery in this world. It doesn't mean to say there's not a lot of very good people who do a lot of things for free and give their time and love and effort for others, but there are many people who will trick you, and I think we're seeing globally more and more on that. So whatever you're doing, use your brain to say, can I trust my counterparty in what I'm doing? And that doesn't mean only little people like you and me. It also means the institutions with whom you're dealing. I'm seeing institutions popping up left, right, and center, which look to me like they're outright frauds. And I won't go into details there, but you can understand what I'm talking about.
Certainly. Definitely make sure you know who you're dealing with. Is a very good principle. Thank you so much, Clive, and God bless.
Thanks very much, Elijah. Bye-bye now.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin weekly specials for June 8th through June 15th, 2026, while supplies last. First this week, pre-1933 gold, MS62 gold $20 Liberties are just $99 over melt per coin. Next, 1-ounce silver kangaroos are $4.50 over spot per ounce. And finally, 90% U.S. constitutional silver is below spot. Call for pricing on specific denominations. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.